everybody, it's Kashayla Link with Caliber Home Loans, and this is my friend
Kimberly Moses with Realty One Group. And we're here today to tell you about different loan types. So there's, three main types of loans, would you say?
Yeah, I would say 3 or 4. So basically what I always say is there's a Bible, right? So you have conventional, VA, FHA, and USDA. Those are basically the 4 different loan types. Then you have subsets of loan types. So you have like conforming conventional, then you have high balance and jumbo, and you have the same basically with FHA and VA. So there's all kinds of different subsets of loan programs, but you generally have those 4 types. Now, out of those 4 types, you have different required down payments. So with VA, there's 0 required down payment. What's nice about that is it allows for you to get it with little out-of-pocket expense. So you're really only covering your closing costs. So closing costs, again, anywhere between $8,000 and $12,000, depending upon when you're closing in your purchase price. Then you have conventional. Conventional, if you're a first-time home buyer, you only need 3% down, as long as it's a primary residence. 5% down if you're not a first-time home buyer. So it's not 20% down like the general public thinks. And then depending upon where your loan amounts reach, will kind of determine what type of loan program you're in within that jumbo.
So what happens
or
if
regular.
You don't put 20% down on your loan?
So if you don't put 20% down on a conventional loan, you will have something called mortgage insurance. So mortgage insurance, what does it do? Well, the simplest answer is it insures the lender in the event that you default. So because you're putting less money down, you're considered a higher risk. So they're going to make you have additional insurance in the event that you don't pay your mortgage payment. So they would basically file a claim with the insurance, take the collateral back, sell it on this, sell it back to somebody else and recoup their costs that way. On FHA, your required down payment is 3.5% down. Now, FHA does have mortgage insurance as well, and no matter how much you put down, you're always going to have mortgage insurance with FHA. So even if you put 20% down on FHA, you're still going to have mortgage insurance.
See, you learn something new every day.
So the premiums for the mortgage insurance will change based upon how much you're putting down and what type of loan program you're going to do. So like VA does not have mortgage insurance, even though you're not putting any money down, but it does have something called a funding fee. So the funding fee is a percentage of the purchase price and or loan amount financed into the loan amount that basically insures the lender. So it's a financed funding fee, but it's not technically considered MI.
So for example, if you were buying a house for $500,000, the funding fee on your first VA, the first time you use your VA loan is like about $15,000?
No, it's going to be a percentage. So just depending upon how much you put down, and depending upon if you're a disabled vet or not a disabled vet, that's all going to change that. So if you put no money down, then you will have a certain percentage. If you put 5% down, it goes down a little bit, 10% down, so on and so forth.
So approximately how much is the funding fee?
So like 3.16 would be a normal funding fee. Like if you were doing a VA refinance.
So for $500,000, that would be about $15,000. It would be a little bit more than $15,000.
Right. Then if you're doing like a refinance from VA to VA, then that would only be like 0.50, like a half a point. That would be the funding fee. And then it can go like to 1.25. Now, if you're a disabled vet, 10% or more disabled, then you are exempt from that funding fee. So the VA then says, medically disabled, they don't have to pay that funding fee. They are exempt from that. So that makes it nice for that. So then there's no monthly mortgage insurance to make that payment higher for that veteran.
Gotcha. So
with conventional, it's all going to be based upon your credit score, down payment. That's how it's going to drive that mortgage insurance premium. And we might have, 10, 12 different mortgage insurance companies that we can price it out with to get you the most competitive insurance for that.
Okay.
And then FHA has 2 different types of mortgage insurance. There's a financed portion like VA. So there's a portion that's financed into your loan amount, and that's 1.75%. And then there's a monthly amount that's 0.85% per month. But if you put more than 3.5% down, it goes down to 0.80. Now, FHA, MI never goes away. You have to refinance out of it into a conventional loan. Now, a conventional loan, if you have MI, once you've paid it down to 22% equity and you've had that for 2 years, that will automatically fall out or you can request it to be removed.
Okay. So we've covered a little bit about conventional, a little bit about FHA and VA. There's also USDA out there, but it's really not used that often because it's
Correct.
meant more for rural areas. So the population has to be under a certain amount for the city that you're buying in. So the cities that qualify for USDA are going to be like Winters, Esparto.
Right. So I wouldn't necessarily put any particular area out. It's going to be property specific is what I'll say. So USDA has a website. So even if, there's some places that are technically located in town that would still be eligible for USDA financing, but you would have to actually search that particular property.
Would that be like county, like what do you call that? Unincorporated.
Not necessarily. So you could even have something that's like right on the edge of town, but because the USDA map still considers it rural, that particular property could be eligible for that. And USDA, I always equate it similar to VA financing because it's 100% financing. There's no MI. They kind of follow with the same linear guideline.
Gotcha. So to recap real quick, you got conventional loans. Minimum down payment is going to be 3%. 3, 5, 10, 20 are generally what we look at for those. Anything under 20% is going to have mortgage insurance. Then we have FHA, which is your 3.5% down payment. It could be more, but you will always have mortgage insurance. VA loans, which are 0 down payment, but you can put more, and then that comes with a funding fee.
Right.
So, and then VAs, you have to be a veteran to qualify for a VA loan.
Well, not necessarily. So, if you are a surviving spouse of a veteran, you could be eligible for a VA loan.
Okay, but so widowed and not divorced.
Correct.
Gotcha.
Yep.